Hello everyone. I will continue with the rest of chapter 6 in this lecture. The next important operation in an insurance company is reinsurance. So in this case, the insurance company writes an insurance policy and it may transfer part or all of the losses to another company. The insurance company which writes the initial insurance is called the ceding company. The insurance company which accepts the insurance from ceding company is the reinsurer. Retention limit is the amount of insurance which is retained by the ceding company, and cession is the amount of insurance ceded to the reinsurer. Retrocession is the process of the reinsurer transferring some or all of that losses to another insurer. So why is reinsurance important? Because it helps to increase underwriting capacity. Whatever policies are written, part or all of it is transferred to the reinsurer. It helps to stabilize profits and it helps to reduce the requirement for unearned premium reserve. So unearned portion of the premium is the one which pertains to outstanding policies. So in case of reinsurance, the requirement for maintaining reserve fund for unearned premium goes down. It provides protection against catastrophic loss. It helps an insurance company to exit any insurance business while the insurance policies are still active. It can also help an insurance company in underwriting in cases where it has little exposure. So these are some of the objectives or some of the advantages of having reinsurance. So these are some of the top catastrophic losses in the US in the recent times and the estimated loss due to these events. So there are two types of reinsurance. One is called facultative reinsurance. In this case, the ceding company goes for reinsurance on a case-by-case basis, especially when it receives an application where the insurance amount is more than its retention. Treaty reinsurance means the ceding company and the reinsurer have a pre-agreed terms based on which the ceding company will transfer excess losses to the reinsurer. There are two basic methods of sharing losses. One is the pro rata method, where the ceding company and the reinsurer share losses and premiums based on a certain proportion. And the other is the excess method. So here the reinsurer pays for losses once it exceeds a certain level. So we will look at different methods which are either pro rata or excess. The quota share treaty involves the ceding insurer and the reinsurer share premiums and losses on some proportion. In this case, it's a 50-50 arrangement. So if there is $1,000 loss, 50,000 is, I'm sorry, if there is $100,000 loss, 50,000 is paid by the ceding company, Apex Fire, and 50,000 is paid by the reinsurer, that is Geneva. In a surplus share treaty, the reinsurer agrees to accept reinsurance in excess of the ceding company's retention. If you look at the example here, the ceding company is Apex Fire, which can provide insurance up to 200,000 for a single policy. The rest, 800,000, is provided by Geneva. So if there is a 500,000 property insurance to be provided, 200,000 of the insurance is provided by the ceding company and the rest 300,000 by the reinsurer. So this is an example of how the policy is issued by the ceding company as well as the reinsurer, and how they uh, distribute the losses whenever it occurs. The excess of loss treaty means there is protection against a catastrophic loss. So the ceding company decides to provide losses up to a certain level in case there is a catastrophic loss. And the excess loss is compensated by the reinsured, maybe up to a certain amount. In this case, if there's a 5 million hurricane loss, 1 million is paid by the ceding company and 4 million is paid by the reinsured. We also have the concept of reinsurance pool. So this is an organization of insurance companies, and they decide to underwrite insurance on a joint basis. It works in two ways. Each member insurance company agree to pay a certain percentage of all losses. So every loss is shared between the member organization. The other way is that the member pays for their share of losses to a certain amount, and the excess loss is shared by all members. There is an emerging trend of using capital markets instead of traditional reinsurance. It can happen through securitization of risk. So an insurable risk is transferred to the capital markets through financial instruments like catastrophe bonds. In catastrophe bonds, the issuer is able to skip or reschedule payments in case a catastrophic loss occurs. There are other types of securitized instruments which we have covered in previous chapters. Next important operation in an insurance company is investments. So the company receives premiums in advance, which they are supposed to use to pay out claims as well as cover expenses. Now, since the premiums are paid in advance, they are available upfront and they can be used to invest in different instruments and earn additional returns. For life insurance companies, the insurance contracts are long-term in nature, and it is important for them to preserve funds. That is a key consideration when they are investing additional funds. For property insurance companies, the contracts are short-term in nature and the payment may happen in the near future. For them, liquidity is an important consideration while doing investments. This is a graph of the trends in life insurance assets over time. This is the distribution of life insurance assets across different financial instruments. Similarly, the distribution of assets across different financial investments. This is for property or casualty insurance. There are other important functions associated with the 6 functions we have described so far. An important one is information systems. So this is digital information available to different departments for taking decisions, for analysis, and so on. We have the accounting department, which prepares financial statements and also does the budgeting. The legal department consists of legal experts who help with underwriting and other activities. In case of property and liability insurers, we also have loss control services. In this case, experts engage with customers and help them to deploy services which helps in risk reduction. That's all for chapter 6. Thank you.